Welcome to the new week, everyone. A week that starts on an ugly note with a violent sell-off in gold and silver setting the tone in the very early hours of trading, as Asia extends Friday's rout and confirms that leverage is still being flushed out. The move is rippling across other asset classes as well. Equity markets are down, bonds are up, the US dollar has stabilized after rebounding from multi-year lows on Friday, a move that was also backed by renewed speculation over the future direction of the Federal Reserve under Mr. Kevin Warsh. Expectations that he could prioritize balance sheet reduction at the Fed are reviving questions about what that means for the free money that markets investors have become so addicted to. So welcome to Swissquote's Daily Market Talk. It's Monday, February 2nd. I'm İpek Özkardeşkaya, and everything I will say here is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
So those who wish that Friday's sharp sell-off in gold and silver prices that shed 9% off gold and 27% off silver would slow this Monday, well, woke up to another nightmare this morning. Both metals, both silver and gold, are heavily sold in Asia at the time I'm talking here, suggesting that the leverage positions and the stops have not yet been cleared just yet. There was indeed a lot of speculation in this market since weeks and months, and that speculative air is coming out quite violently right now. Now, looking at the levels for gold, I was pointing last Friday at a possible correction toward the 4,600 to 4,800 per ounce range in case of a sell-off here, and we're already near $4,600 per ounce support this morning at the time I'm talking here. I must admit that the sell-off has been way harder and way faster than I or many expected. This morning, the minor 23.6% Fibonacci retracement on October 2023 to last week's rally has already been cleared. And given the high volatility that we have here and the size of leverage positions over the past months, well, the sell-off could well deepen toward the 50-day moving average that currently stands near the $44.80 per ounce level, and further down toward the 200-day moving average that currently stands near the $42.35 per ounce level. And the major technical level that I watch here sits at a distant $41.15 per ounce level. That's major 38.2% Fibonacci retracement on late 2023 to last week's rally, and I believe that this very level should hold strong if the sell America and sell the US dollar theme remain in play and intact due to the waning trust in the White House and its trade and geopolitical policies. For silver, the rally on the way up was faster than gold, remember, last year, so the correction on the way down is faster too. Silver was down by more than 26% on Friday's trading session in a single session, another 13% this morning, and losses are being printed faster than I can finish my sentence. Overall, silver gave back nearly 40% of its gains since last week's peak. At the time I'm talking here, and more importantly, slipped below two important technical levels. One is a 50-day moving average, and two is a major 38.2% Fibonacci retracement. These levels are being cleared this morning, and the latter, especially the Fibonacci level, suggests that silver steps into the bearish consolidation zone this morning with the possibility of deeper losses before the correction slows. But how deep? Well, the next key Fibonacci level is a 50% retracement that stands a touch below the $70 per ounce mark. That also has the merit to be a psychological level, mind you. Hence, could be a speed bump here for the silver losses. I would expect a few dip buyers there indeed. But below that, major 61.8% Fibonacci retracement near the $57.80 per ounce level would be a level to watch, I would say. And whether the metal's latest sell-off will be an opportunity to return for a fresh start at lower levels, especially for those who missed the rally, well, depends on many factors, including the US dollar and its strength. And while the US dollar is better a bit since Friday, the dollar index actually rebounded 1% off of 4-year lows on the news that the Fed has a new chair. Yes, Kevin Walsh was chosen to be the next Fed president. If he is confirmed, he will be replacing Jerome Powell when Jerome Powell's term ends in May. Now, this nomination marks the end of the ongoing suspense about who will be the next Fed chair and gives some hints regarding where the Fed could be headed next. Judging by his past views, Mr. Walsh has been quite vocal and critical regarding the Fed's leadership, its monetary policy, and especially its relentless expanding of the balance sheet. He has sounded very concerned about inflation as well, that shattered Main Street's purchasing power while pushing asset prices higher in the meantime. Hence, he is expected to opt for some balance sheet reduction at the Fed. And if he does so, there will be room to bring this balance sheet back to pre-QE levels. I mean, look, before 2008 crisis, the Fed's balance sheet was worth less than $1 trillion US dollars. In 2022, it went all the way up to $9 trillion US dollars, and today is standing at about $6.5 trillion US dollars. That means that Walsh could mark the end of free money for the markets, and that's bad obviously, and that could pose a major problem for US long maturity bonds obviously, and also the US indices that have been on a multi-decades long climb and partly on this free and abundant cash. So no wonder the knee-jerk reaction to Walsh news was a spike in the US 10-year yield on Friday. That's actually lower this morning though, certainly, as the cash coming out of metals is now somehow flowing into the US bonds. But in the longer run, and longer run meaning 12 months and more, a smaller Fed balance sheet, narrowing size of that balance sheet can only add pressure on the yields to the upside. On the inflation side, well, Kevin Walsh doesn't like inflation. The White House, on the other hand, couldn't care less about inflation. The president just thinks that the cost of living crisis is a hoax and he just wants lower rates to help businesses grow. So no one really knows if the Fed under Mr. Walsh would or would not be more reluctant to cut the interest rates in the US. But the reaction in the US 2-year yield tells that investors still think that Walsh will cut the interest rates because he thinks that reducing the size of the Fed's enormous balance sheet, along with the productivity gains from AI, will ultimately lead to lowering inflation. And I won't lie, I agree with him on this point. The Fed's monstrous balance sheet was going to be addressed one day, and that day could be today. So what will that mean for equities? Could lower interest rates reverse the possible impact of smaller Fed balance sheet? Well, it all depends on how fast the balance sheet loses weight, right? To be honest with you, the United States and the global economy have become so addicted to this central bank money that weaning markets off this free money could be so painful that some actually think that whatever Walsh thinks, today, the Fed's balance sheet could end up bigger under Walsh than it was before him. Now, today, the European and US equities are poised to kick off the week by a sharp sell-off, and that despite the falling yields. The risk-off clearly dominates the market narrative today, this morning. A risk-off that has partially and ironically triggered by a sell-off in gold that's supposed to be a safe haven, right? So if gold cannot protect you against the market sell-off, what could? The Swiss franc. I know the SNB will hate me for saying that, but Swiss franc can. The dollar franc trades below 78 cents level right now, suggesting that negative rates could be back on the menu for the Swiss this year, but I'm not sure that that will slow the appetite for the Swiss franc. Anyway, this week, the European Central Bank and the Bank of England are expected to do nothing on their rate policies. The Reserve Bank of Australia, on the other hand, is expected to hike rates. So these policy divergences will create great opportunities in the FX space that investors will be loving, in my opinion. And in the equity space, it will be a big week of earnings announcements. Palantir and Disney are due to announce their earnings today, AMD tomorrow, Google and Qualcomm on Wednesday, and Amazon on Thursday. Note that better than expected results from Meta, Microsoft, and Apple couldn't necessarily bring the bulls back last week. That's because investors are becoming too picky regarding where the cloud growth, for example, comes from AI or not from AI, and whether all this AI investment is justified by actual returns. So it won't be a walk in the park, and there will be a lot to talk about, and we will talk about everything in detail about what to expect from these earnings and the reactions throughout this week. But this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, on WhatsApp, on Threads, on Telegram, and on Blue Sky, everywhere you can imagine for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.